A lot of financial advisors, YouTubers, and stock market gurus talk about compounding and then go on to say, in order to make the most out of compounding, you need to invest in the stock market. But a lot of people are left to wonder how exactly compounding works in the stock market. Like, it's easy to understand, like in the case of, say, a fixed deposit. But how exactly does compounding work in the case of stock? Well, today I will explain to you how compounding exactly works in the stock market and what are the steps that you need to take in order to achieve optimum results. First step is to start early. The earlier you start, the more time you give your wealth to compound. The legendary Warren Buffett started at the age of 11 and now he has a net worth of $110 billion. It doesn't have to be a huge amount that you invest every month. It can be a small amount. Just make sure you're saving and investing every single month and being consistent about it. The second most important thing is that you must avoid withdrawing from your investment from time to time. If you keep withdrawing from your investment, you're not exactly giving compounding a chance to work for you. Now, this is easier said than done. We all have expenses in our life which are unavoidable. So it is your responsibility to identify these expenses which can be avoided and cut them down. This is exactly why compounding is so hard. You need to have a lot of patience and make a lot of sacrifices. If it was easy, everyone would have been rich. Now, the third most important thing that you need to do is, whenever you sell a stock or get dividend, you need to reinvest those funds into the stock. When you reinvest your return, you're increasing your capital, which in turn is helping you grow your wealth at a much higher rate. The fourth thing that you need to do is invest for the long term. Now, in stocks, you don't exactly get a fixed rate of return every year. You compound your wealth in stock through price appreciation. Now, for example, let's say a stock you bought doubled in 5 years. Does it actually mean that the stock gave you a compounded return of 14.87% every single year? No, it doesn't. It could also be a case where stock did not move at all in the first 4 years and then went on to double in the 5th year. Now, if you had sold the stock after the first 4 years, your wealth would not have compounded at all. This is why you need to have a lot of patience and have a long-term investment horizon so that you are holding the stock when the price actually appreciates. Incurring a huge loss actually dampens the process of compounding. One thing that you can do to protect your upside and avoid incurring a huge loss is to place a sell limit or a stop loss order with your broker. A stop loss order is an order placed with a broker to buy or sell a specific stock when the stock reaches a certain price. For example, you set a stop loss order 10% below the price at which you bought a stock. This limits your loss to 10% when that stock reaches that certain price. To protect your upside, you can place a sell stop limit order. A sell stop limit order consists of two prices: the stop price, which activates the limit order to sell, and the limit price, which is the lowest price that you're willing to accept from the buyer. Protecting your upside and reducing your downside can help you compound your wealth over the years. Last but not the least, you need to be patient. The real benefits of compounding take time. Remember earlier I told you Warren Buffett's net worth was $110 billion? Well, guess what? 107 out of the $110 billion came after his 65th birthday. He started early and was patient throughout. To make the magic of compounding work for you, you need to give it time. People often talk about the magic of compounding in the investing world. We hope after watching this video, you have a better understanding of what this magic exactly is and how you can use it to work for you while investing in stocks. To keep watching all the investment related updates, please subscribe to Groww.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.